When it comes to retirement planning, a lot of focus and energy goes into the various investment options and building out a great portfolio. And while that's important, as viewers of this channel know, choosing the right investment is just one piece of the puzzle. You also need a solid strategy for withdrawing your money in a way that minimizes taxes. Ultimately, it's not just about what you earn, it's about what you keep on an after-tax basis, because one of the biggest threats to your retirement income is going to be taxes. And without optimizing your tax plan, you could end up paying more money than necessary. Now, if you've been watching this channel for a while, you know I've spent a lot of time doing deep dives into various strategies to help you optimize your tax plan. But today I want to pull back a bit and I want to talk about 6 types of income or pools of money that can potentially be tax-free in retirement. But first, my name's Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Now, the third thing I'm going to talk about today, I haven't heard a ton of people reference in a while because it's kind of fallen out of favor. But I think with some of our changing financial situation, I think it can make sense for more and more people. But I'll talk about that more in a minute. So let's dive in. The first pool of money, or the first place you can pull some income from in retirement that can be incredibly tax efficient, is a health savings account, also known as an HSA. If you qualify for an HSA, it is one of the best and most tax efficient accounts out there because it is triple tax advantage. Your contributions are tax deductible. The money inside the account grows tax-free, and when you use it for qualified medical expenses, withdrawals are also tax-free. Now, there are some downsides or some things you should know, and one of the biggest issues is to open up an HSA, you have to have a qualified high-deductible health plan. So you can't just go down to your local brokerage and open up an HSA account. You have to have a qualifying health plan. Now, once you have the qualified health plan, you can then open up an HSA account and begin contributing money to receive your tax deduction. Now, one of the big mistakes I see people make is they get a qualified account, they open an HSA, they start putting money into the account, but they never actually invest the money. Most companies will allow you to invest the money in your HSA once you build up at least $1,000 in the account. But there's another problem. Even when you open the account and you fund the account and you invest the account, most people of HSAs use the money on healthcare expenses as they pop up. But there's a little known bonus. You can reimburse yourself tax-free for previous medical expenses, even if they happened years ago, as long as they happened after you opened your HSA, and as long as you keep the receipts. So let's walk through how this could actually work in practice. So you open up an HSA account, you put in $500 a month, $6,000 a year, and you invest the money, and you don't spend it, you don't touch it. Well, that money begins to grow and begins to compound. In year one, you have $6,000 at the end of the year. But then you have all the growth in the market, assuming the market goes up. And then the next year, you put another $6,000 in, it begins to compound, it begins to grow and begins to grow. Just putting $500 a month into an HSA with no inflation adjustments at the end of 20 years, assuming an 8% annualized rate of return, that $500 a month has turned into an account with $274,000. Much of that is tax-free growth. Now, you've been spending money on healthcare expenses that you haven't been reimbursed for over the past 20 years. You went to the doctor, you had deductibles, you had copays, all these various things. Well, what you can do is you can write a check from that HSA account for all your past medical expenses since the beginning of the HSA plan. You can write a check out of the account and it comes out completely tax-free. So if you have room in your budget, you want to pay your medical expenses out of pocket, allow that HSA money to continue to compound, and then at some point in the future, either use it to pay for healthcare expenses in retirement or write yourself a check and pay yourself back all the medical expenses that you've paid over the past few years. Next, let's talk about qualified dividends and long-term capital gains. If your taxable income falls below a certain threshold, and it's fairly high, you can receive both qualified dividends and long-term capital gains completely tax-free. And this is especially useful in retirement if you can manage your taxable income carefully and stay within the 0% tax bracket for long-term capital gains. For the right person, it can be a great way to generate tax-free income. Now, I've done an entire video on this topic, and I will link to it in the description because this is just a high-level overview. For 2025, if you are a couple and you are married filing jointly and you earn under $96,700 a year, so almost $100,000 all of your long-term capital gains up to that point and all of your qualified dividend income up to that point is completely tax-free. Now, if you have $50,000 in Social Security and $50,000 in annuity income and some income coming in from rentals, that's going to fill up that bucket really quickly. But if you have no other income coming in, you could potentially have $96,700 a year in long-term capital gains or in qualified dividends and pay no taxes. But it gets even better because on top of that, you also have the standard deduction, which the standard deduction for a married filing jointly couple in 2025 is going to be $30,000. So you take $30,000 and you add that to $96,000, and that's the amount of income that you can potentially earn completely tax-free. Now, if you're a single filer, you can earn $48,350 plus the $15,000 standard deduction before you'd begin to have to pay tax on your long-term capital gains or your qualified dividends. You can make over $125,000 a year as a married filing jointly couple before you would have to pay any tax on your long-term capital gains, or $63,000-ish as a single filer. So with proper tax planning, you can keep your tax bill incredibly low. Now, I should mention this strategy only works with the taxable brokerage account. And that's true of the next strategy as well, the third strategy or the third pool of money. So let's discuss municipal bonds. As I mentioned, this strategy has fallen out of favor, partially because interest rates are so low, and interest rates on municipal bonds tend to be even lower than the interest rates on, say, corporate debt. But when you invest in municipal bonds, so state and local government bonds, the interest income is generally exempt from federal income tax. And if you buy bonds issued by your state, it may be exempt from state taxes as well. So this can be a fantastic source of tax-free income, especially in retirement. If you are in a higher tax bracket and you have a taxable brokerage account, it might make sense to look at municipal bonds. Now, the problem is, as I mentioned, is the yield or the coupon rate that you earn on these bonds tends to be a bit lower, but on a tax-adjusted basis, depending on your income level, it might make sense to have municipal bonds in your portfolio as opposed to corporate bonds, because once you take the tax deduction, the yield, the tax-adjusted yield could actually be higher than what you would have received on a corporate bond if you had to pay tax. So particularly in your taxable brokerage, if you have bonds in your taxable brokerage, you want to think about municipal bonds. Now, there are a couple of caveats. Most municipal bonds are tax-free, but certain bonds like private activity bonds could still be subject to the AMT tax. So you could potentially, with your municipal bonds, be subject to AMT. The other thing to point out is the income from your municipal bonds, it gets added into your provisional income from Social Security. So let's say you have $50,000 a year coming in from your municipal bonds, it's all tax-free, but then it's time to take Social Security. That $50,000 is going to get added into the provisional income strategy with the Social Security Administration and could cause your Social Security benefit to be subject to tax. So you want to be sure you check the fine print before you build your entire retirement plan around municipal bonds. Next, another great source of tax-free income is downsizing or tapping the equity in your home. So let's say you have a home that's in Southern California. You paid, say, $500,000 10 years ago. That home is worth $1 million today, and you want to downsize or maybe move to a state with a lower cost of living. And so you have $500,000 in capital gains on the house. Well, if you are married filing jointly, you can take $500,000 in gains from selling your home completely tax-free. Now, you have to have lived in the house 2 of the past 5 years to qualify. If you are a single filer, you can take a $250,000 gain completely tax-free. You could also take advantage of the 0% tax bracket. So you might be able to take out even more than $500,000. So if you're thinking about selling your house and you're thinking about downsizing, this can be a great source of tax-free income. The other thing you need to know is not only can you take out that money completely tax-free, but you can also increase the basis in your home. Let's say you paid $500,000 in the home, but you redid the kitchen and you spent $50,000. Now your basis isn't $500,000, your basis is $550,000. Or let's say you added an additional room on the house and you spent $100,000 on it. So you paid $500,000 for the home, you spent $50,000 in a kitchen, and you added a room on for $100,000. Well, now the basis on the home is not $500,000, it's actually $650,000. And so if you sell the home for $1 million, your gain is only $350,000. So you want to keep track of the enhancements you make to your home, like adding an additional room or renovating the kitchen or renovating a bathroom or adding a fence or a swimming pool or whatever it might be, because that is going to increase the basis of your home and mean you can pull even more money out of your home completely tax-free. So if you have a home that is appreciated a lot and you plan on selling it and maybe downsizing or moving to a place with a lower cost of living, that can be an incredible source of tax-free income. Next, let's talk about one of the favorite topics for people who watch this channel: qualified Roth distributions. If you've been diligently saving in a Roth IRA, or maybe you did some Roth conversions a few years ago, it can be a powerful bucket of tax-free income. As long as you're at least 59 and a half and you've held the account for at least 5 years, your withdrawals from a Roth IRA are completely tax-free. So you pay no taxes on the earning. So if you put $100,000 into your Roth IRA and today that account is worth $1 million, you have $900,000 in gains, you can take out all that money completely tax-free. It is one of the best ways to ensure a reliable source of tax-free income in retirement. One of the things you're trying to do in retirement is you're trying to move around all these different puzzle pieces, and you're trying to keep your taxable income as low as possible so you don't have to pay tax on your Social Security income, and so you don't have to pay a Medicare surcharge. If you earn too much money, you're going to have to pay more money for your Medicare premiums. And so you want to keep your taxable income as low as possible. And one of the best ways to do that is through qualified Roth distributions. Now, I've spent hours on this channel talking about Roth IRAs, particularly Roth conversions. Should you do a Roth conversion? Shouldn't you do a Roth conversion? But at the most basic level, without getting too in-depth, a Roth IRA is one of the most powerful tax planning tools in your disposal when you're planning for retirement. Next, let's talk about Social Security benefits, which is core to most people's retirement plan. What some people don't know is that your Social Security benefit can be completely tax-free. Actually, it's tax-free for about 50% of recipients. It depends on your combined income or your provisional income, which is this formula, which is your adjusted gross income plus your non-taxable interest, think municipal bonds, and half of your Social Security benefit. Now, with a good tax strategy, you can minimize the taxes on your Social Security benefit, leaving you more money to spend. Now, in this video, I'm not going to talk about what those particular limits are because I have another whole video that I will link to in the description, and then I'll also link to a playlist at the end with a few relevant videos, and I will include my video on how Social Security is taxed and how you can avoid tax on Social Security. But one thing I will tell you is that more Social Security recipients are having to pay tax on their Social Security benefit because the combined income or the provisional income thresholds are not pegged to inflation. And so more people are seeing their Social Security benefits subject to tax. But with proper planning, you may be able to avoid tax on your Social Security benefit, giving you more money to spend. Here's a bonus income source that's tax-free that hopefully you don't ever have to use, but life insurance proceeds are tax-free. So if you have a life insurance policy, the payout to your beneficiaries is generally tax-free. So I didn't include that in my 6 income sources, but just thought that I'd throw that in there. I hope this video was helpful and helped you optimize your tax planning. Now, many of the topics I talked about today, I have much more in-depth videos on. So I have a video on how you can pay 0% tax on your long-term capital gains and how you can avoid tax on your Social Security and how the provisional income works, and all. It's very in-depth. So I put some of those videos together in a playlist, and you can watch that playlist now. You can binge watch these videos. And as I've said before, I hear it is great for sleep. So I hope they help you rest well.